one of the things that we need to talk about if we're going to be a real estate channel is the seasonality of real estate. And in order to have this conversation, we have the one and only housing, Mr. Lance Lambert. How you doing, sir?
Doing great, really good. And yeah, we're kind of moving from the seasonally strong half of the year for appreciation, and we're kind of moving into that seasonal period where some of the people who went a little too high at the end are kind of like, you know what, maybe I need to pull this price down a little bit from the seasonal peak.
Yeah, so you put out a lot of amazing stuff on Twitter. I look at it every day now. You put out a piece 2 or 3 days ago reminding people what 2022 looked like and where we are in 2023. So for the folks that didn't see that tweet, remind us what happened in 2022.
Yeah, so 2022, we had a, a 10.5% increase in US home prices in the first 6 months of the year.
Wow.
That's a raging spring market.
Yeah, it is.
10% in 6 months. And if it would have sustained, it would have been the biggest year ever, only eclipsing the prior year where we had 19 something percent appreciation in 2021. And what happened, of course, is that mortgage rates spiked 3, 4, 5, 6, 7. We actually had some corrections and prices coming down off of those peaks. But it's still in the second half of the year, even though we had declines in a lot of places, we still finished up for last year 5.6%, which is just above a normal or like a historically normal year. It's still kind of strong appreciation. And then we came into this year and we flipped out of that slump in the second half of last year. And, prices have been resilient on very low volumes, but prices have grown through the first half of the year. And it's not just in the places that were more resilient last year. It's everywhere, just about. Even the Western parts of the country saw price gains in the first half of the year.
Yeah, I think this warrants more discussion because I think if we are operating in an environment where the seasonal rush of new inventory, aka the spring selling season, doesn't materialize because of either A, affordability or inventory or whatever reason, we may have more years like 2022. And I'm not talking the 10%, the numbers, but I'm talking about where the first half is hot and the second half is cold. And why this is important is last year, and you and I talked about this, coming into January, off the seasonally slow period, everybody was a housing bear. And I'm like, you guys don't get it. There's no inventory. This is going to be a flat market. I mean, but there were people calling for 20%, 10%, all of that. Then we have the spring selling season. Shocking, I know. And now everybody's less of a bear. So we got to watch where we are in the cycle. That's why I love this conversation,
Yeah.
reminding people.
Well, and so that brings up a good point too, where 6 months ago, the sentiment was very bearish.
Yes.
And then
Very.
now we had, 3.5%, or, really we're up 4% from the bottom. And if home prices did not grow at all the next 12 months, we would be up year over year in January, 4%.
Yeah.
Like that's already there. But then it's a question of, his sentiment now went too far. Like, are we back into growth market, or are we about to get head faked a little bit and it be more of a sideways? And that would be, we go into the second half of the year, and as we move into the seasonally slow period, the other side of the market that is the headwind, which is deteriorated affordability,
Correct.
pushes prices down. Like we give up some of the gains. Because right now there's a clear tailwind to the market. Its existing inventory is so tight. That is why
Correct.
prices are up this year. Existing inventory is so tight. That's the tailwind. The headwind to the market is that affordability is deteriorated at a historical level, and it's pressurized right now.
Yeah.
And so we were able to see gains in the first half of the year, but it's like as we go into the second half of the year, does the deteriorated affordability, work against the market now that it has seasonality there? And it'd be interesting to see. There are a lot of places now that have went from, you know, thinking that, this was going to be a little bit of a flat year to now they're very bullish. And that's like Zillow. They think prices are now going to move up 6% from here over the next 12 months. And for that to happen, we can't have a weaker second half of the year. It would just kind of be tame, like not really declines, maybe even a little bit of gains. American Enterprise Institute, they think we're going to be up 6% this year and 7% next year. That's
Gosh.
clearly like
Wow.
the market's moving. And CoreLogic, who is the one of the very few that has never had a negative year-over-year call. They think we'll be up like 4.5, which is what they always kind of think. But
But it's the historical average is 4.6, right?
yeah, credit to them for putting their necks out like that,
Yeah.
because they took a lot of heat last year. And so those groups are kind of moving into a little bit more bullish. We're kind of out of this. Prices are going to move up regardless of a deteriorated affordability. There's just not enough supply. I would call that their
Yeah.
narrative.
Yeah.
The sideways calls are more of like what we just talked about, which is, as we move into the second half of the year, the deteriorated affordability working a bit against the market.
Yeah.
We did just get a new call by Morgan Stanley,
Mm.
and there's for the US, and they're talking about how, the housing market is starting to turn a corner globally, a lot of these markets, and, residential fixed investment, housing GDP is bottoming the second quarter of this year, which we just got the negative print for GDP for residential fixed investment today. And then next quarter and on, we're up for residential fixed investment. But what they think is going to happen to prices is Morgan Stanley thinks that 2023 ends up flat, which for that to happen, we're already up 3.8% this year. So we'd have to get those blown off. So you're already in a tight spot for that type of call. And then they think that next year prices will fall 2% as affordability continues to adjust slowly back to long-term averages and inventories begin to slow climb out of multi-decade lows. The thing there is we just haven't really seen that yet, right? We saw a jump in inventory last year as days on market spiked and mortgage rates went up. But ever since November, it's firmed up. And even the gains we've seen this year aren't that much. And Bill McBride last week in his newsletter, he said that the inventory gains last year were the head fake. And so, this Morgan Stanley call is interesting. But as of right now, we're not really seeing that in the data.
It's funny that Bill would.
We get inventory up.
Yeah, it's funny that Bill McBride would bring that head fake up because he and I actually had a friendly wager, a dollar bet. I remember it specifically. I think we spoke in September.
Him or John?
Oh, you're right. It was John Wake. You're right.
Yeah.
I'm sorry.
Yeah.
Sorry. Same market, but different area. So I will stop the story. Basically, inventory was the head fake. So yeah, you're right. Thank you for the correction. I speak to so many people. But back to seasonality. This is what I think both the bulls and bears are missing. This is kind of the point of the conversation. The spring selling season, absent supply, means prices go up. In the winter, absent demand, prices go soft. And I think that seasonality, until there is a legitimate spring selling season, meaning more supply, it might repeat itself in 24 and 25 and 26. This lock-in that you and I've talked about is going to take years to unlock, in my opinion.
Yeah. Yeah. There's just no progress. There's no momentum. And really in everything in housing, we've had like 6 months of, or maybe like 5 months, we kind of like know a lot of what these stories are, which is existing inventory volume super constrained. There's not a lot coming into the market. Demand is still way down, but supply is down even more. And so the equilibrium for the spring was price appreciation. The builders who made the affordability adjustments, they've seized the market, and they're getting, the best of the demand.
And
And
correct, you probably read it in detail. I only read one article. We got new home sales yesterday, I believe, and they beat expectations. The big takeaway for me is price points are down, which again I think is a good thing. I think median price went from like 418 to 414 or some jump like that. A drop in median price, but that's because they're building smaller homes. They're not building the mansions anymore. Now they're building the condos and townhomes. At least that's how I get there, right? You sell
yeah.
more homes, the
Well,
price points down.
well, they did. There was a correction for prices, and it varied. But now, some of the prices are moving up for some of the builders. They've been moving them up this spring, and
Okay.
it looks like that's going to continue because when you look at land prices are a huge leading indicator for
Yeah,
price. Like a
correct.
lot of real estate economists believe that landowners, not builders, are the ones who absorb the gains from house prices, and they kind of do it they're ahead of the game.
Yep.
Is
Yep.
the theory there. But in terms of even if that median were to move down more from here, probably not too much likely, but it would be maybe because they're building smaller, even as prices are starting to move up. Uh,
Yeah,
but
they could build smaller and technically make more margin. I mean, that's possible.
Yeah, but the thing I'm trying to get to there is the affordability adjustments happened second half of last year into the
Correct.
Q1 2023 communities opening up. And now it's kind of like, it's moving the other direction. They're pulling back on some of the incentives.
Yeah.
The money at close will slowly start to get smaller and smaller. The buy downs less juicy as time moves on, and those backlogs are reduced.
Yeah.
And yeah, but we kind of know what a lot of these stories are, and the institutional side is still very constrained. It looks like we're going to be going through a period where there's some consolidation, and some of the bigger ones maybe taking some of the portfolios of the other ones, especially like Starwood Capital, which has a little
Yeah.
bit of stress from their commercial real estate stuff.
They need some cash. They need some cash,
Yeah.
those guys.
Yeah, so it's kind of interesting to see what all plays out, and to see if we actually. And here's the biggest thing: the biggest thing here is, are these forecast models correct that we're going to start to see mortgage rates come down a bit
Yeah,
over the next 6 to 12 months?
you're
Uh,
right.
does that actually happen? Because that would slightly improve affordability. And that not necessarily the best thing for the market either.
Yeah, no,
Um,
I've actually been very clear about this. We've learned, and I've evidence from agents, top 1% agents across the country. 7% stops the market, slows it down. 6%, 599, not good. Demand comes off, no new supply, and we're off to the races again. So I hope we're in this. I hope we stay around 6.5. We just need time to get through this.
yeah. So here's the things I think that could slowly ease the market.
Okay.
One is labor softens more, and that's
Correct.
the mechanism that rates come down. Because if all else is equal and rates come down, even if it brings more churn to the market, like some people are like, oh, I'll sell my home now. They're then going to go buy because that's the only people who are sidelined. So that's demand and supply. And then it just pulls in outright demand that's just sitting there that
The
doesn't bring
marginal buyer. Correct.
marginal buyer pushes in. So that's not great. So if you're going to have rates coming down, you need it happening in an environment where labor has weakened. You need
Significantly.
you need some weakening and softening there and kind of breaking us out of some of this overheating. I think that's the only way that rates moving down is maybe, more positive. The other thing is you still do need, like Jerome Powell said yesterday, we have a historic number of units under construction. They're mostly on the multifamily side. But if you bring in more multifamily supply, and that tames rent growth there, and that keeps this large divide between house prices and rents, that could work against the market a bit too with the
Sure.
fundamentals.
Yeah.
But it's just hard to see where much inventory is going to come from because we've already been hit by the mortgage rate shock, and it hasn't deteriorated demand. It hasn't even taken days on market back to pre-COVID levels.
Exactly.
That's one of the key problems here is, okay, we needed mortgage rates to rise to help to restore balance in the market. And then, oh, by the way, it happened. We went from 3 to 7%. And then days on market didn't even make it all the way back to pre-COVID levels. Because if that happens, you do get more active listings purely by markets, homes sitting on the market longer.
Correct.
And we're kind of getting back to normal.
That is like, if you were going to ask me one metric I'm looking at is days on market.
Yeah.
That's going to be my sign for at least the next 6 months, how slow it, and I expect it to go up. I mean, it could double from here. But that is the metric I'm looking at.
And all I'm trying to talk about too here is things that are going to help to get the market to where it's in a normal like in a normal level of appreciation or below normal, so we could get some real declines on an inflation adjusted basis and get some of this market, back into a healthier spot. Because right now, if home prices don't grow at all this year, like we're flat the rest of the year, we would still be up on a real basis too for the year, because we're up 4%. So that's above inflation. And I think wages are kind of in the 4 or 5, and some people use wages to do real house prices instead of actual overall CPI. But still, like, if we get even, we didn't even get a real decline this year.
Yeah.
So
pretty
far.
Amazing. Pretty amazing. Well, you're housing. You are an awesome follow on Twitter, and of course a writer for Fortune. How can people find you?
Yeah, people can find me at News Lambert on Twitter, or search Lance Lambert Fortune in Google to find my stories.
Awesome, buddy. Thanks again.